The Iran shock is coming. Most people are going to misunderstand it because most people always misunderstand the first stage of a crisis. They will think the story is oil. They will think the story is a war headline. They will think the story is whether crude goes to one price or another price next week. That is not how I would look at it. When I look at a shock like this, I do not start with the headline. I start with the chain of causes and effects. I ask what happens first, what happens second, what gets squeezed, who becomes fragile, and which strong systems become more valuable, because the world around them becomes more chaotic. That is the important part. Oil prices are rising. When oil prices rise, they do not simply make gasoline more expensive. They push through the entire economic machine. Transportation becomes more expensive, production becomes more expensive, food becomes more expensive, materials become more expensive, the cost of moving things, making things, and delivering things rises at the same time. That creates inflationary pressure. And when inflation rises at the wrong point in the cycle, the Federal Reserve has a very difficult problem. If the economy slows and inflation is low, the central bank can cut rates and give the system relief. But if the economy slows while oil is pushing inflation higher, the central bank cannot easily rescue the economy without making the inflation problem worse. That is why stagflation scares people. Stagflation means the economy is weak, jobs are under pressure, businesses slow down, consumers get squeezed, but prices are still rising. It is the kind of environment where weak companies get exposed. Weak balance sheets break, weak households feel pain, weak businesses lose access to capital. And the people who have not prepared are forced to sell at exactly the wrong moment. That is the first thing to understand. A crisis is not just an event, it is a stress test. When the system is calm, almost everything can look strong. When money is easy, rates are low, oil is stable, and sentiment is good, many weak things can appear healthy. But when energy prices rise, inflation pressure returns, and uncertainty spreads, the weak parts of the system reveal themselves very quickly. This is why I do not view market crashes the way most people view them. Most people view a crash as the end of the game. I view a crash as the point where the game separates the prepared from the unprepared. For more than a century, markets have followed a pattern. The reasons change, the mechanism changes, the panic changes, but the cycle repeats. There was the dot-com collapse, there was the subprime and mortgage crisis, there was the pandemic crash, there was the inflation and bear market of 2022. There will be other shocks, there will be other wars, there will be other financial accidents, there will always be another reason to panic. That is how history works. The event is always different. Human behavior is usually the same. People become greedy late, they become afraid late, they buy when the price has already gone up and sell when fear has already done its damage. Then, after the market recovers, they look back and say the opportunity was obvious. It was never obvious emotionally. It was only obvious if you had principles before the panic arrived. That is why I believe the coming shock should not simply be feared, it should be understood. I do not want to chase fear. I do not want to chase headlines. I do not want to gamble on oil because oil is moving. I want to understand which businesses become more important if the world becomes more unstable, more expensive, more energy constrained, and more dependent on technology. That distinction matters. If oil prices rise because of geopolitical tension, it is easy to say, buy oil that might work for a period of time, it might work for 3 months, 6 months, or a year, but I do not think about building wealth that way. Oil is cyclical, it rises, it falls, it moves with supply, demand, politics, production, storage, and fear. It can be very profitable for traders who know what they are doing, but I am thinking about the next 10, 15, and 20 years. I do not want to own something only because a crisis makes it popular for a short time. I want to own the kinds of businesses that can compound through the crisis and come out of it stronger. That is the principle when a shock hits. The market often sells everything first. It does not carefully separate strong companies from weak companies in the first wave of fear. It throws out good assets with bad assets because liquidity, emotion, and forced selling take over. That is when great opportunities are created. But you cannot simply buy anything that falls. That is the mistake. You need to know in advance what you would want to own if the market gives you a better price. You need to build a shopping list before the store goes on sale. You need to know which companies have the strength to survive the stress test and benefit from the world that comes after it. Survival is the key word. Amazon is one of the clearest examples. It survived the dot-com crash. It survived the financial crisis. It got badly hit. It looked dangerous at the time. But the business survived, improved, and compounded in 2008. The stock could be bought for a fraction of what it later became. That is what great businesses do after they survive. They take share, they grow, they benefit from the next cycle because the weaker competitors disappear or fall behind. This is why I do not want to waste my attention on trying to guess the exact bottom of a crisis. That is not a reliable game. The reliable game is to understand the cycle, prepare emotionally, keep liquidity, avoid leverage, buy slowly, and focus on businesses whose long-term economic engines remain intact. The Iran shock, if it develops the way many fear, could pressure oil. Oil pressure could feed inflation. Inflation could limit the Fed's ability to help. Consumers could get squeezed. Smaller and weaker businesses could be hit hard. Fear could return to markets. That is the bad part. The good part is that this same environment can create one of the last major wealth building opportunities of the decade for investors who are prepared and disciplined. Not because chaos is good, chaos is not good, but chaos reprices assets. It forces investors to distinguish between what only worked in easy money and what actually solves structural problems in the real economy. So the question is not what will go up tomorrow. The question is what becomes more necessary in a world of geopolitical risk, expensive energy, inflation pressure, AI infrastructure demand, supply chain uncertainty, and productivity pressure. When I ask that question, I do not arrive at a single stock. I arrive at groups of businesses. The first group is reliable power. That is where the logic begins. Artificial intelligence is the most power-hungry technological wave we have ever seen. It is not just software running quietly in the background. It requires data centers. Data centers require electricity. Electricity requires generation, transmission, cooling, reliability, and redundancy. And the more the world becomes dependent on AI, the more critical reliable power becomes. If oil prices rise and the energy system becomes more stressed, the businesses that help provide dependable power or reduce dependence on fragile grids become more valuable. This is why energy matters in a long-term portfolio. But I do not mean energy in the simple cyclical sense. I am not talking about chasing oil producers because oil spiked this month. I am talking about energy that compounds with technology. There is a big difference. Traditional oil exposure can move with the oil cycle that may be useful for some investors, but it is not the same as owning businesses that help solve the structural power needs of the AI economy. The kind of energy I want to think about is connected to reliable power, nuclear power, cooling, and on-site energy production. One company on that list is CG, which was added in March of 2025 and has risen since then. The reason it matters is nuclear. Nuclear is not a headline trade. It is a long-duration answer to a long-duration problem. If the world needs more electricity, more reliability, and lower dependence on unstable energy flows, nuclear becomes part of the conversation again. Another company is VRT, which was added earlier and has moved much more. VRT is tied to cooling and infrastructure. Data centers do not just need power, they need to manage heat. As AI workloads grow, the cooling problem becomes more important, not less important. This is a picks and shovels type of business in the AI infrastructure cycle. Another is Bloom Energy, which was added in February 2026 and has already moved strongly. Bloom Energy is about on-site production and less dependence on the grid. In a world where the grid is under pressure, where data centers need reliability, and where companies do not want to be vulnerable to energy bottlenecks, on-site power becomes a much more important idea. That is the first sleeve. It is not about chasing the price of oil. It is about understanding that AI, geopolitical risk, and energy reliability are connected. The second group is memory. This is one of the places where many investors are still not thinking clearly enough. When people talk about artificial intelligence, they usually talk about GPUs, they talk about NVIDIA, they talk about compute. That makes sense because the first phase of the AI boom was very much about compute capacity. But as AI gets more complex, the bottlenecks change. If we ask AI to do more complicated things, use longer context, handle agents, run more complex workflows, and remember more information, the need for memory rises dramatically. The more complex the system becomes, the more memory it needs. That creates a structural problem. The world was not fully prepared for that level of memory demand. Just as the world did not have enough GPUs when AI demand exploded. It may not have enough advanced memory as the next stage of AI expands. And in memory, the market is concentrated. A small number of companies control most of the industry. Micron, SK Hynix, and Samsung are central players. For investors who prefer a US-centered portfolio, Micron becomes especially important. Micron has been under pressure since being added to the list. But that alone does not invalidate the thesis. In long-term investing, the question is not whether the stock immediately rewards you. The question is whether the underlying need is real, whether the company is positioned to serve that need, and whether the cycle eventually turns in its favor. Micron is tied to high bandwidth memory, the type of memory AI data centers need. If AI workloads continue growing and memory becomes a bottleneck, the companies that can supply that memory can benefit enormously. The revenue growth and free cash flow growth in the source data were strong, but the deeper point is simpler. AI needs memory, and memory capacity cannot be expanded overnight. It can take years to build production at the required scale. That creates a window. For the next several years, the companies already positioned in that market could have substantial pricing power and demand support. That is why memory belongs in the discussion. The third group is production. If energy powers the AI system and memory helps it function, production is what builds the physical foundation. The semiconductor supply chain is one of the most important systems in the world. It is also one of the most geopolitically sensitive systems in the world. In normal times, production capacity matters. In chaotic times, it matters even more. This group includes NVIDIA and AMD because they address the GPU side of the bottleneck. NVIDIA has already created extraordinary gains since being identified, and AMD has also risen significantly. But the logic is not simply that these stocks have gone up. The logic is that the world's AI ambitions require compute, and compute requires advanced chips. Then there is ASML. ASML is different because it makes the lithography machines that make advanced semiconductor production possible. This is not a normal business. It has a monopoly-like position in one of the most critical parts of the semiconductor value chain. If the world wants more advanced chips, the world needs the machines that make them. Then there is TSMC. TSMC is the manufacturing giant that actually builds many of the most advanced semiconductors. It is central to global chip production. It sits at the heart of the system that makes it powerful, but it also makes it part of the geopolitical risk map. In a world of rising uncertainty, the value of production capacity becomes more obvious. Then there are the design and software side companies like ARM and Cadence, and connectivity companies like AET. They are not always the names the average investor focuses on first, but they are part of the same production ecosystem. Chips are not just manufactured, they are designed, connected, tested, integrated, and deployed. This is why I think in systems rather than isolated tickers. A single company may be exciting. A system tells you where the durable demand is when the world becomes more unstable. The companies that help produce the core components of the technology economy become more important. They may fall during panic, they may be repriced sharply, but if their long-term role remains essential, those drawdowns can become opportunities. The fourth group is decision-making in chaos. This may be the most important idea psychologically. When the world is calm, people think decision systems are optional. When the world becomes chaotic, decision systems become essential. If supply chains are uncertain, if geopolitics are unpredictable, if energy prices are moving, if companies need to react quickly, if governments need to understand complex information, the ability to make better decisions becomes a strategic advantage. That is why Palantir belongs in this part of the discussion. Palantir is not simply a software stock in this framework. It is a company built around helping organizations make decisions in complex, high-stakes environments. That is why it has done so well since being added to the list. The market can argue about valuation, insider selling, government exposure, commercial growth, competition, and hype. Those things matter at different times. But over the long term, what matters most is whether the business continues to improve its revenue, margins, and usefulness. The source pointed to the key principle: long-term stock prices follow revenues, profits, and margins, not the daily noise. That is exactly how I think about it. The market can produce endless arguments. Some will sound very intelligent, some will be right for a week or a month. But if a company's revenue keeps growing and its gross margins, operating margins, and net income margins keep improving, the long-term economics tend to pull the stock in that direction. That does not mean price does not matter. Price always matters. It does not mean risk disappears. Risk never disappears. But it means that the long-term investor should not let short-term noise become more important than business reality. CrowdStrike fits into the same broader chaos framework through cybersecurity. If the world becomes more digital and more unstable, cyber risk rises. Organizations cannot ignore security. A cyber failure can damage operations, reputation, and trust. That makes cybersecurity mission critical. Datadog and MongoDB relate to databases, visibility, and monitoring. Oracle, Microsoft, and Google matter through databases and cloud infrastructure. Amazon also fits here through AWS, although it also fits in the automation and productivity group. These businesses are part of the same deeper trend. The more complex the digital economy becomes, the more valuable it is to see clearly stored data properly, protect systems, and make good decisions under pressure. The fifth group is automation and real-world productivity. This is where the conversation becomes especially important in an inflationary environment. If oil prices rise, inflation stays stubborn, and labor costs remain high, productivity becomes more valuable. Companies need to do more with less. They need automation. They need better advertising efficiency. They need better logistics. They need better financial platforms. They need tools that allow the real economy to keep functioning despite higher costs and uncertainty. Tesla belongs here because of robotics and full self-driving. Whether the timing is easy or difficult, the larger idea is automation. If real-world automation works at scale, it can change labor, transportation, logistics, and productivity. Meta belongs here because advertising efficiency matters. In difficult environments, businesses still need customers, but they become more careful about the return on every dollar they spend. A platform that can deliver better targeting at lower cost becomes more important. Amazon belongs here because it combines AWS with retail data, logistics, and operational scale. The stock has not done much over certain recent periods while the business itself has improved. That kind of divergence can matter. When a company gets better and the stock does not reflect it for a long time, the future opportunity can become interesting if the fundamentals continue improving. SoFi belongs here as a financial platform, and Robinhood deserves an honorable mention for similar reasons. Financial activity is becoming more digital. The platforms that capture that behavior can benefit if they execute well. These are not random names. They are connected by a principle in a chaotic, inflationary, technologically accelerating world. The companies that provide productivity, automation, decision-making, infrastructure, power, memory, and production can become stronger on the other side of the shock, but having the right companies is not enough. You also need the right system. This is where most people fail. They think the hard part is picking the name. It is not. The hard part is behaving correctly after you pick it. You can identify a great business and still lose money if you panic, use leverage. Buy too much too fast. Chase momentum, sell during fear, or confuse volatility with permanent impairment. That is why I believe in a disciplined buying process. Dollar cost averaging matters because no one knows where the bottom is. A shock can last longer than expected. Panic can go deeper than expected. A stock that looks cheap can become cheaper. A market that looks washed out can wash out again. That is not a reason to avoid investing. It is a reason to size properly and move slowly. You should not use margin. You should not borrow to buy. You should not turn a long-term investment idea into a forced liquidation risk. Debt changes the psychology of investing. It can take a good thesis and destroy it because you lose control of time. Time is one of the greatest advantages an investor has. Margin can take that advantage away. I also believe a portfolio should have a strong S&P 500 core. Many people think they can outperform the market purely through individual stock selection. Some can, most do not. The index gives you broad participation in the productive power of the economy. Individual stocks can add targeted exposure to the themes you understand best. But abandoning the core because you are excited about a list of companies is usually a mistake. The right structure is not about ego. It is about balance. You want a core that keeps you grounded and targeted sleeves that let you express your highest conviction ideas. You want enough cash or flexibility to buy when prices fall. You want a process for adding slowly. You want to know what you own and why you own it before volatility arrives. The companies discussed here share several characteristics. They are not just energy trades. They are tied to structural demand. They can thrive in chaos or provide tools that become more valuable in chaos. They offer certainty, reliability, productivity, or mission, critical infrastructure in uncertain times. They are best in class or positioned near critical bottlenecks, and their fundamentals over time need to support the thesis. That last point is essential. A good story is not enough. A great narrative can make a stock exciting, but over the long term, the business must deliver. Revenues must grow, margins must improve, cash flow must matter. The company must become more useful, more profitable, or more strategically important. This is why I do not lose my balance when a strong stock falls during a panic. If the thesis is broken, I reassess. If the thesis is intact and the price is lower because the whole market is afraid, I pay attention. That is the difference between risk and volatility. Volatility is the price moving around. Risk is permanent loss of capital caused by weak fundamentals, bad balance sheets, poor business models, excessive leverage, or buying without a margin of safety. Most people confuse the two. They think a falling price means increasing risk. Sometimes it does, sometimes it means opportunity is improving. You only know the difference if you understand the business, the balance sheet, the cycle, and the role the company plays in the system. This is why preparation matters more than prediction. I cannot predict the exact path of the Iran shock. I cannot tell you where oil will be on a specific date. I cannot tell you how the Fed will react to every data point. I cannot tell you when the market will bottom, but I can prepare a framework. If oil rises, inflation pressure increases. If inflation pressure increases, the Fed's flexibility decreases. If the Fed's flexibility decreases, weak businesses and consumers are squeezed. If fear spreads, strong businesses may get sold down with weak ones. If strong businesses with durable demand get sold down, disciplined investors may get opportunities. That is the chain. The chain is what matters. When you think in chains, you stop reacting to headlines and start preparing for outcomes. And the history of markets should keep you rational since the 1930s. Bull markets have tended to be longer and larger than bear markets. Bear markets are painful. They feel like they will never end when you are inside them. But the productive economy does not stop forever. Companies adapt, earnings recover, innovation continues. Consumers return, capital gets redeployed, the world keeps moving. There will always be wars, there will always be crashes, there will always be recessions. There will always be reasons to sell. But over long periods, the market has risen because revenues and profits rise. That is why sitting entirely in cash can feel safe while quietly destroying purchasing power. Inflation is the slow bear market most people do not notice until too late. A crash is visible. Inflation is subtle. A crash makes you afraid. Inflation makes your money worth less while you are congratulating yourself for being safe. Over 25 years, purchasing power can be dramatically eroded. If you hold cash forever because you fear volatility, you may avoid the pain of drawdowns, but you accept the certainty of losing purchasing power. That is not safety. Safety is having a plan that allows you to survive volatility and protect purchasing power over time. So if the shock comes, I do not want to be emotional. I want to be ready. I want to know the businesses I would like to own. I want to know the themes that matter. I want to know the difference between cyclical trades and long-term compounding assets. I want to keep my buying process slow and disciplined. I want to avoid leverage. I want to maintain an index core. I want to use weakness intelligently. The key is not to be fearless. Fearlessness is often just ignorance. The key is to understand what you are afraid of, define it clearly, and build a process that prevents fear from making your decisions for you. If the market falls because oil rises, inflation returns, and the Fed is trapped, many investors will panic. They will sell what they should be studying. They will chase what already moved. They will hold cash too long. They will buy too fast or sell too fast. They will treat headlines as strategy. I do not want to do that. I want to follow principles. The principle is that strong businesses survive. Strong businesses that survive crises can become generational wealth creators. But you must buy them with discipline, patience, and an understanding of the system they belong to. Energy reliability belongs in the system. Memory belongs in the system. Semiconductor production belongs in the system. Decision making in chaos belongs in the system. Cybersecurity, cloud, databases, visibility, automation, advertising efficiency, logistics, robotics, and digital finance all belong in the broader system. These are the areas I would want to study before the panic becomes obvious. That does not mean every stock is a buy at every price. That does not mean every company mentioned will work. That does not mean the market cannot fall much further. It only means that if the world is going to become more energy constrained, more data dependent, more AI driven, more geopolitically uncertain, and more productivity focused, these are the types of businesses that can matter more, not less. The worst thing an investor can do is enter a crisis with no framework. Without a framework, every red day feels like confirmation that the world is ending. Every green day feels like proof that the opportunity is gone. You get pulled back and forth by price action. You become a prisoner of emotion. With a framework, volatility becomes information. It tells you where fear is. It tells you where liquidity is being pulled. It tells you where investors are overreacting. It gives you a chance to compare price against long-term value. That is why I want a shopping list, not because I know exactly when to buy, because I know that when fear arrives, I will not think clearly unless I have already done the work. The work must come first. The watch list must come first. The position sizing must come first. The decision rules must come first. Then, when the world gets loud, I can stay quiet. That is the real advantage. Most investors are not beaten because they lack intelligence. They are beaten because they lack a process. They buy stories. They sell fear. They confuse activity with discipline. They think the market owes them certainty. It does not. The market gives you probabilities, it gives you cycles, it gives you stress tests, it gives you moments where weak hands sell good assets, it gives you opportunities only if you have the emotional and financial capacity to use them. So as I look at the coming Iran shock, I do not see a reason to panic. I see a reason to prepare. I see a reason to understand how oil connects to inflation, how inflation connects to the Fed, how the Fed connects to consumers, how consumers connect to corporate earnings, and how corporate earnings connect to stock prices. I see a reason to identify the strong businesses that could survive the pressure and benefit from the next expansion. I see a reason to avoid short-term commodity chasing and focus on long-term systems. I see a reason to keep cash available without hiding in cash forever. I see a reason to buy slowly, never use margin, and keep a broad market core. And most of all, I see a reason to remember that history does not repeat perfectly, but human behavior repeats often enough to make principles valuable. Every crisis feels unique while you are living through it. Every crisis feels obvious after it is over. The investor's job is to bridge that gap. You do that by thinking in cause and effect, respecting cycles, preparing before the panic, and buying only what you would be willing to hold through fear. That is how I would approach this. Do not click because of fear. Do not buy because of excitement. Do not sell because the headline is terrifying. Sit down, write out the chain, understand where the stress goes, identify the businesses that solve the problems created by that stress, and build your plan slowly. The next crisis may hurt unprepared portfolios. It may also create extraordinary opportunities for people who understand the difference between temporary panic and permanent value. That is how wealth is built in difficult periods, not by predicting every headline, not by being braver than everyone else, but by being more prepared, more rational, more patient, and more principled when the cycle does what the cycle has always done.